Thank you, everyone, for making it through the day. A lot of exciting discussions and presentations. The last session is a special session. We are presenting the inaugural CBER Circle Insight Award. I'm delighted to announce the award winner. We announced it previously, which is for this particular paper, Flashboards 2.0. It's a paper that many of us have read and actually have changed industry discussions and practices. The CBER Circle Insight Award is something that we decided to do for the first year, but we hope to do many years in the future as well. It is one way to encourage research, especially for younger junior faculty that are at the cusp of deciding which areas to focus on. And oftentimes I hear of stories of APs saying that, well, love to do research in DeFi or crypto, but perhaps that's not the best avenue for publishing, or it's a difficult field. So the point of this award is to encourage research in this very innovative field that is still very much needing research to move industry and move regulation forward. So today I have the pleasure of introducing our jewels. By the way, I should actually thank a couple of people. Fahad, who is probably in the audience, who have worked very hard with me on this award, as well as a committee that have come together to select the award, including Ken Brofgarden, David Yamak, Joshua Gaines, and Christine Parler. As a committee, we selected this paper as the first paper, but hopefully there's many to come. So, Ari, I'll let you take over.
Thanks very much, Gordon. I'm delighted to be here today. I'm going to give a short retrospective on the paper and then talk about a new idea my group introduced a few weeks ago. Back in 2014, Michael Lewis published a book entitled Flashboards. It became a somewhat celebrated expose on the practice of high-frequency trading on Wall Street. And Lewis called out 3 characteristics of high-frequency trading. This is my summary, not his. The first is the use of arbitrage bots, or algorithms, rather than a human in the loop to conduct trading. A second is something that I'll refer to as front-running. Wall Streeters would probably object to the way that I'm using the term, so I'll explain what I mean by it later. And the third is the quest for speed, a big investment in improving latencies, achieving low latency. And the book provoked a flurry of investigation. There were fines and so on and so forth. The pros and cons of high-frequency trading, as you probably know better than I, are heavily debated. But I think what the book made clear is that Wall Street does not present a level playing field to the ordinary investor. Well, things are supposed to be different with blockchains. Bitcoin, as you'll recall, was born in 2008, 2009, amid the financial crisis of that period. And inscribed in the first block, the so-called Genesis block of the Bitcoin blockchain, is a reference to bank bailouts. Instead of being controlled by a single financial institution or a collection of financial institutions, it's a community-run system, of course. And this has had pundits waxing rhapsodic about how blockchains can, quote, help build integrity into all our institutions and create a more secure and trustworthy world. Well, the sage words of John Kenneth Galbraith are particularly pertinent here. The upshot being that in the world of finance, there tends to be a neglect of history, and we will see that to be the case in the blockchain community. Let me illustrate what I mean. Let's suppose that Alice and Bob want to trade. Alice has a cryptocurrency like Ether, and Bob has created some new token called Bob's Bubble Token. And they would like to trade. Well, Alice would like to buy 1 Bubble Token for 1 Ether. Well, they have 2 challenges here. First, they need to find one another. They need to identify counterparties in this type of trade. And second, problem I'm going to focus on a little bit more, they need to achieve what computer scientists refer to as fair exchange. In particular, it should not be the case that Bob sends a bubble token to Alice and doesn't get paid. Both of them should receive the asset that she or he is entitled to in this swap. And this is what centralized exchanges are designed for. And what a centralized exchange does is bring parties together and help implement a fair exchange, act as a kind of custodian, so that if all goes well, Alice sends her asset, her ETH, to the exchange, Bob sends his bubble token, and the exchange will execute a swap. So Alice gets her bubble token, Bob gets his ETH. Well, this is what happens if all goes well. If things don't go well, of course, this can happen instead. A thief comes and makes off with the assets in the exchange. In other words, exchanges are vulnerable to hacking. Hacking has been an all too regular occurrence. Here is a brief list of some of the largest hacks to occur in the community affecting centralized exchanges. Since 2011, there's been something like 2 billion siphoned out of exchanges that have been hacked. Now, this is one thing that can go wrong with centralized exchanges. Of course, other things can go wrong as well, like this. We're all familiar with FTX and the fallout from the collapse of FTX. Okay, so how can we solve this problem, the problem that exchanges are not inherently trustworthy? Well, I said that the blockchains were designed to restore trust or create new models of trust in the financial industry. So a natural solution is to replace this thing with a blockchain or blockchain functionality. In particular, you can design an exchange to operate as what's called a smart contract, an application that runs on top of a blockchain. Such applications are referred to as decentralized exchanges, or DEXs. The most popular DEX design is what's known as an automated market maker, or AMM. And in a nutshell, the idea is that the AMM holds its own assets. These programs can actually hold cryptocurrency. Smart contract can custody cryptocurrency. And users, rather than trading with others, Alice, rather than having to trade directly with Bob, trade against the automated market maker. But there are two unfortunate problems with AMMs and with smart contract systems more generally. Two unfortunate facts. The first is that transactions are public. What I mean by this is that if Alice wants to trade with the DEX, she sends it a transaction, and that transaction passes through a queue of pending transactions that's referred to as a mempool. It will sit there until it gets processed. And while it's sitting there, it's visible to the whole world, to good actors and to not so good actors. That's the first problem. The second problem, one fundamental to the design of blockchains today, is that transaction ordering is actually centralized. This is kind of the dirty little open secret of blockchains. They're decentralized systems that are temporarily centralized. What do I mean by this? I mean that when transactions enter the system, a validator, previously known as a miner, the entity that adds blocks to the blockchain, ingests these transactions and places them in a block. But the validator gets to decide which transactions are in a block, and critically, it gets to decide how those transactions are ordered. So the validator may have seen transaction 1, then transaction 2, then transaction 3 enter the mempool, but it's perfectly free to reorder transactions. It might swap 2 and 3, it might reorder these transactions entirely. That's the second unfortunate fact. Okay, so what? What's the big deal? It turns out that this matters, and it matters a lot, particularly in relation to DEXs. Let's suppose that Alice wants to buy some BBT. She's not going to interact with Bob now. Instead, she's going to place an order with a DEX, with a smart contract. So she wants to buy 1,000 BBT, and the current price is 1 ETH per BBT. In isolation, then, she should get 1,000 BBT. Okay, this is all well and good. Now, observe that when she conducts this trade, as happens in any kind of exchange, she's going to cause the price of the asset she's buying, BBT, to rise. Well, a validator, of course, is going to observe Alice's transaction here before it gets processed. After all, the validator is responsible for placing it in a block. What the validator can do is insert its own transactions into the block in a way that exploits Alice's transaction. In a sense, the validator here gets to look into the future. It knows that a buy order is going to be placed by Alice. And if you know that the price of an asset is going to rise because a buy order is going to be placed, you can buy that asset in advance. The validator has this ability by placing its own order in the block. So the validator can buy up, say, 1,000 BBT before Alice does. Alice then buys some BBT. Notice she's getting fewer BBT than she would have in the absence of the validator's transaction. She causes the price to rise, and now the validator can capitalize on Alice's transaction by turning around and selling its BBT at an elevated price. The impact is that Alice loses BBT, her pocket has been picked here, and the validator makes money. This is referred to as a sandwich attack. It involves what I referred to as front-running, namely the placement of this transaction here by the validator prior to Alice's. Turns out not just validators, but bots can do this too. They can do this in ways that I'll describe in a few minutes. We observed this behavior and measured it, studied it, in a paper published in 2020. Lead author was Phil Diane, my PhD student at that time. And we coined a term to characterize the value that a user is exposing in her transaction to validators or bots that are trying to exploit users' transactions. We called it, at the time, minor extractable value. Today, it tends to be referred to as maximal extractable value because these systems no longer have what are technically called miners, but validators. Okay? But MEV was the term that we coined for this phenomenon. At the time that we published the paper, the era in which we published the paper is what are referred to as the bot war era. What was going on is the following. User would place a juicy transaction, nice front-runnable transaction from which a validator, miner at the time, could extract a lot of money, or a bot could extract money. And what would happen is that a bot would observe this transaction in the mempool. Remember, these transactions are public when they're in that pending queue, and front-run Alice. And the way that it would do this is by paying a high gas price, as it's called. This is the fee for the processing of the bot's transaction. And it turns out that generally the way that blocks get organized, or got organized at that time, was such that higher fee gave you priority position in a block. So the bot would in essence pay a little bribe to get its transaction in ahead of Alice's, and it could therefore take advantage of Alice's transaction. Well, of course, if one bot observes Alice's transaction, there's a very good chance that a second bot will observe Alice's transaction, and additionally observe the transaction of the first bot. So often a second bot would come along and try to front-run both Alice and the first bot by paying an even higher gas price, a higher fee, to get even greater priority for the placement of its transaction in a block. Well, first bot doesn't have to take this lying down, right? It's going to observe the behavior of the second bot. What is it going to do? It's going to pay an even higher fee. And there was a back and forth between these bots, which I'll talk about in a minute. The upshot here, though, of course, is that the user gets exploited by one or the other bot. And this makes Alice very sad. But as it turns out, Alice is or wasn't alone. We documented in our paper some of the pleas of users who had lost money, and in some cases significant amounts of money, as a result of this phenomenon. They posted pleas to the bot masters, those running the bots, to return the money they'd lost. And some of these are heart-wrenching. I placed a mistaken order for just a couple of seconds. I'm a stay-at-home parent. I made a mistake. Please send it back. This was an accident. I'm a single parent trying to make ends meet at a job I hate. Please have some mercy. Please. And these pleas go on and on. Probably the most disturbing one was this one. So poor Rajesh here gathered up all the rupee in his village and sent in a transaction and got attacked by a bot and lost all of it, and one shudders to think about what happened to him as a result. As I said, there are many, many more of these. and a number of them are documented in our paper. Back to this dynamic, back and forth dynamic between the bots. The bots you can think of as participating in a kind of auction. If you think of the fees that they're paying, these gas fees to get priority position, they're essentially bidding in an auction conducted by the validator. You can think of it in those terms. And it turns out that we're engaging in a rather unusual and interesting game. You can think about a game theoretically. To begin with, this game has imperfect information because although one bot can see the other bot's transaction, it takes some time for that transaction to propagate from one bot to another through the mempool. So information is imperfect here. It's a continuous time game. Although the bots are taking turns, they're not doing this in discrete intervals. They're doing this against wall clock time. It turns out to be what's referred to as a partial all-pay game. In particular, the losing bot still had to pay a gas fee. So even if one bot got front-run by the other, it would still have to pay a fee for its transaction, therefore it would lose money. And at the time, these games were probabilistic duration because the interval between the production of blocks was a random variable. Now in some systems, the interblock interval is regular. Okay. We analyzed this game theoretically. As I said, you can think about this game from a game theoretic standpoint and found that there was a Nash equilibrium, and a rather interesting one, in which each bot raises the other by the minimum possible amount. And it's called a grim trigger strategy at play. If one bot deviates from this behavior, the other bot will jack up its gas payment to the point where both bots lose. They both lose money. This is what we found. And very satisfyingly, we found a convergence over time toward this equilibrium. In other words, this was one of the rare instances in which a simple mathematical model actually predicts real-world behavior. It did this in two critical respects. The first is that, as I said, the model predicts that bots will raise one another in terms of gas fees by the minimum possible amount. Well, the clients, the software used in the network at that time, allowed for a minimum gas fee or payment raise of 12.5% or 15%. You can see over time that bots converged to raises of exactly 12.5 or 15%. We also saw another feature predicted by the model, a latency war. To give you a sense of the type of latency wars you see on Wall Street, there's an excellent incident recounted in the Flash Boys book. In fact, the book opens with a discussion of a company called Spread Networks. It was building a fiber optic cable at great expense, hundreds of millions of dollars, between Chicago, the Mercantile Exchange, and the New York metropolitan area, trading floors in New York. It did this to cut latency for message transmission between the two cities by just a few milliseconds. Well, by the time the book came out, this was already obsolete. Somebody had built a microwave link between Chicago and New York, but shaved yet more time off the latency to transmit messages between the two cities. So latency wars are pervasive on Wall Street. Well, it turns out that speed is also helpful in this game that I've described, this bidding game indexes. And we can see that the speed of the bots participating in this game improved over time. Notice the latency between moves by bots dropped gradually over time. What I just described was the early era, the archaic era, if you will, of MEV extraction. Things changed quite dramatically at the end of 2020 with the emergence of an organization called Flashbots. Flashbots observed that this back and forth bidding between bots was causing congestion in certain blockchains, particularly the Ethereum blockchain. They referred to this as a negative externality. They decided to address this and to try to achieve three goals that sound rather lofty. The first was to democratize access to MEV revenue. Second was to bring transparency to these bot wars. And the third was to redistribute the revenue extracted from users' pockets. To give you some sense of the ethos at this organization, Flashbotters refer to themselves as a pirate hacker collective, a term I absolutely love. Okay. Their key idea for doing all of this was to systematize the auctions I described. And rather than having them happening on the blockchain, to have them happen off-chain in a system that Flashbots itself built. The initial system they built has evolved considerably over time. And the main current incarnation is something called MEV Boost. This is an early version of a long-term plan in the Ethereum ecosystem called PBS, Proposer Builder Separation. Some people refer to this rather elaborate system as the MEV supply chain. This is basically an auction system for MEV, for the right to order transactions selectively and extract value from users' transactions. I won't describe it in detail, but in a nutshell, there are various entities that construct blocks in the hope that they will get picked up and added to the blockchain by a validator. A validator gets to choose among these different blocks constructed by entities known as builders. And the one it will pick is the block that is most profitable to the validator. In particular, each of these blocks includes a kind of reward or bribe for the validator. The one that offers the biggest reward to the validator is naturally the one that the validator picks up. How much money are we talking about here? This is a multi-$100 million a year industry, on-chain alone. I'm not even talking about arbitrage and centralized exchanges, which involves even more money. But since the merge in Ethereum, an event that took place in fall of last year, about $300 million in MEV has been extracted. Okay, well, what about these lofty goals, the democratization and redistribution of MEV? It turns out that the vast majority of MEV is going to validators because of this reward system. I don't know the exact figure, but it's somewhere north of 90%. Let me give you an informal proof that there is no way to escape this phenomenon, that MEV competition is an inevitability. Suppose that a validator is offered two blocks, block B and block B star. And block B pays reward R. Remember I said blocks carry rewards for the validator. And B star carries reward R star, and R star is larger than R. Which one is the validator going to choose? Well, of course, it's going to choose the block with the richer rewards, and choose the block B star. Where does this reward come from? Well, it turns out that these rewards come from MEV. When a block is built, MEV gets extracted, and some portion of that MEV, in fact, most of that MEV, is incorporated into the block as a reward for the validator. Well, that means that the block with the highest MEV extraction is the one that's going to go on chain, because that's the one that offers the highest reward to the validator. Okay? So simple proof that MEV extraction is inevitable. Now let me prove that MEV competition is not inevitable. Suppose a validator, again, similar setup. Validator is offered two blocks, B and B star. B pays reward R, B star pays reward R star. R star is greater than R, which is the validator can choose. Of course, it's going to choose B star. But where does the difference in the reward come from? Well, suppose we can create a system in which B star includes some extra transactions that have been fairly ordered and which come from private order flow. So they could not find their way into the blue part of the block. In other words, we append some transactions that have not had MEV extracted from them. Well, these two blocks then are identical, except you've got this batch or bundle of fairly ordered transactions coming, as I said, from private order flow. In this case, the block that's going to be chosen by the validator is one in which, at least on a per transaction basis, you don't have the highest amount of MEV extraction. You have some transactions from which MEV hasn't been extracted. So the flaw, if you will, in my previous proof was the assumption that all transactions are available to all block builders. If they're available only on a selective basis, then MEV extraction, in fact, doesn't have to be inevitable. As I said, I'm briefly going to discuss a system that my group proposed just a couple of weeks ago called PROF, until it was proposed by an academic. PROF stands for Protected Order Flow. And I won't get into the technical details, but in a word, what PROF does is take a block that a validator is about to add to the blockchain and append to it some fairly ordered transactions in such a way that those transactions can't be tampered with. And in fact, the validator only learns those transactions after it has committed to the block B star that includes them. And we use, as I said, various technical mechanisms to protect the order flow in that green part of the block. If you do this, then you're basically giving the validator a choice. Either you can take the block you're originally going to mine, or validate, I should say, add to the blockchain for reward R, or you take the block with the fairly ordered transactions, and you accept the extra epsilon reward embodied in R star. So this is attractive to a validator. It's also attractive to users, of course. User has a choice. User can send her transaction into the mempool and expose the MEV in her transaction, or she can pay some tiny amount of money to the PROF system. PROF system has to make this epsilon reward available to the validator, and pay some tiny amount, like a penny, or maybe a fraction of a penny, to get her transaction into the green or fair part of the block. That's the idea behind PROF in brief. Now, what do I mean by fair ordering? Well, basically, I mean anything you like. Transactions, for instance, can enter the PROF system in encrypted form and be sequenced before they get decrypted, so that there's no possibility of learning about the contents of the transaction and exploiting, or transactions and exploiting them. You could use what's sometimes referred to as temporal fair ordering, first come, first serve ordering, the deli ticket model, if you will, of transaction ordering. You can actually use both of these things. They turn out to be complementary, or you can use neither. You can use some completely different mechanism. PROF is agnostic to the mechanism that gets used to build this green part of the block. So pick your favorite fair ordering mechanism. If you'd like to learn more about PROF, as I said, this is a proposal that we published just a couple of weeks ago in a blog post. You can find it on the IC3, or Initiative for Cryptocurrencies and Contracts website. Here's the URL. You'll easily find the blog post. Let me wrap up there. Thank you. I don't know if we have time for questions, but if we do, I'm happy to answer.
Just a very dumb question. You said that the validator gets to choose between B and B star, yet you're adding the transactions in. You said the transactions are added after the validator commits. So how does the validator actually get to make both the committing to the B star?
No, so the validator chooses whether it wants to validate B or whether it wants to engage the PROF service to enrich B and produce a block B star. What I said was that it's only after committing to B star that it will get to see those green transactions. If it takes the other path, it chooses just to validate the block B, it will not become privy to the PROF transaction.
So to motivate how PROF would work, you basically said that transactions could be encrypted before they get accepted. Can't you just do this by default for all transactions and then you don't have to worry about it in the first place?
So the question is, could you encrypt transactions by default on blockchains?
That's right. So that
Well, yeah, unfortunately, blockchains natively can't manage secrets, and therefore they can't manage decryption keys. You need some adjunct to a blockchain in order to be able to do this. And a system like PROF is an adjunct of that type.
just very briefly, so because the Flash protocol is now used very widely by almost all the blockchain users, right? So there's that after the change. So are you really proposing that the PROF protocol would be becoming the default then?
My hope is that the PROF protocol will become the default because it sidesteps this problem of MEV being extracted from the transactions of what are basically victimized users.
Who retains the decryption keys?
Who retains the decryption keys? That depends. In the architecture we're proposing, the main architecture, a piece of what's called trusted hardware, trusted execution environment, would maintain the decryption keys. But you could alternatively use what's called secure multi-party computation and distribute the decryption key among a committee of servers or nodes.
So you need like an SGX Intel chip.
Yes, exactly. Okay.
So I understand how the prof system helps with information leakage and particular sandwich attacks, but sort of proposing FIFO ordering, you still have the same kind of latency games, right? Like still there's an advantage to being faster, the same as in traditional financial markets.
Yeah, indeed, temporal fair ordering does have some limitations, but you can, as I said, combine it with what's called secure causal ordering, encrypted transactions. Essentially, you get the best of both worlds. Both have their limitations. You combine them, you get something better than either in isolation. As I said, you can pick your favorite fair ordering mechanism, and Prof is agnostic to the one that you choose.
Could Alice and the other individuals compete with their little money and that will spin out of control?
Could Alice and other entities compete with their money?
I mean, for their transactions, like the sandwich attack. I can come and I may overbid Alice for my own transaction.
Yeah, and in what way would they compete, or what is the...
If I will increase Alice's, then I'll get priority. I'll pay 2 pennies.
Oh, I see. It depends on the ordering mechanism that Prof uses. Prof could conduct an auction, but it doesn't have to conduct an auction. As I said, it could, for instance, process transactions on a first-come, first-served basis, in which case that opportunity doesn't arise.
Can I sandwich the entire prof set of transactions?
No.
But even if I can place at the top of the next block?
So there are two things that protect the Prof bundle. One is that the contents of the Prof bundle don't get revealed until after the block has been validated. So although you can place transactions in the blue part of the block before the Prof bundle, you have no idea what's in the Prof bundle at the time that you do it. Okay, so this is one thing protecting them. A second is that the Prof bundle must be appended to the end of the block. And as I said, we use technical mechanisms to enforce this append-only rule.
But then just a follow-up, but then the fair ordering, so the details, you didn't get into much into details, but the fair ordering part seems to be a bit redundant, while the fact that, as you just said, I am committing before knowing anything seems to be the key element here. Or
Well,
something.
the fair ordering part is essential. How fair ordering is achieved, as I said, fair ordering can be achieved in a number of different ways. One of those is to order transactions within that green part of the block before they get revealed to anyone. That concealment of the transactions, that protection of the confidentiality of the transactions is a service that Prof has to provide. That's not provided natively by the infrastructure.
What fraction of the block should be the prof section?
What fraction of the block should be the Prof section? My hope is that eventually it will be 100%, because the system will be more attractive to users.
But to make,
To begin with, yeah, I don't have an answer to that.
Yes, my question about adoption of the profs. So if there is not enough adoption from the validator or proposer side or builder, then the user will have a delay risk or exclusion risk because next slots may not be proposed by a person or validator using prof. And at the same time, if you can think about all the validators or proposers or builders, there might be a few other reasons they may not want to use prof. For one reason, if all of them are using prof, they will lose all the MEV they're extracting now. And then, because all the other go
Well, I'm not gonna, yeah. But you're basically asking a couple of questions. First question is, what happens if Prof only sees sporadic uptake? Indeed, users will incur some latency. But users who are trying to avoid MEV extraction are already incurring that latency. There are institutions running their own validators to sidestep flashbots. And you mentioned that validators or others in the infrastructure may not want to make use of Prof because they're going to lose out on MEV opportunities. That may be true, but if their users sending transactions to the prof service, they are engaged in this simple game of either accepting a prof bundle or not, either accepting the epsilon reward or not. They don't have a choice as to whether those transactions get shunted into the public mempool. So to put it another way, prof should be self-propagating. That's our hope at any rate.
Can prof be used to implement sanction the same way that flash process?
Can prof be used to implement sanctions? Prof is not deciding unilaterally what transactions are incorporated into a block. It doesn't become a choke point, so no.
Yeah, I want to know which MEV prof is killing, because sandwich might be very bad for the victims, but other like arbitrage and liquidation might actually be creating efficiency in the financial market.
Yeah, I haven't thought about whether prof is going to impede beneficial forms of arbitrage, but I suspect not. That's something we would have to explore. I should probably end here because we're over time. Thank you very much.